the Eurodollar. Eurodollar is not a great name considering they're not European, has nothing to do with euros, and they're not even really dollars. So if that's the case, then what exactly is a Eurodollar and how does it present potentially the biggest risk to the global financial system since the Great Depression? To answer that, we have to take a trip back in time to 1944, the Bretton Woods Agreement. Prior to 1944, countries around the world were all on their own version of the gold standard, meaning that people used paper currency, but that paper currency was backed by gold at their own central banks. Well, after World War II, most advanced nations had spent all of their gold on paying for all of the waste from World War II, and they were all out of gold. Instead of starting over and rebuilding from scratch, though, the United States had a ton of gold. So countries around the world got together at Bretton Woods in 1944 and agreed to peg all of the world's currencies to the dollar, making those currencies exchangeable for the dollar, and the dollar at that point was still exchangeable for gold. This was called the Gold Exchange Standard, and the rest of the world went along spending their own paper currency, knowing that it was backed by dollars and trusting that at any point they would be able to exchange those US dollars for gold held in America. Now, this system worked out for a while, but the name of this game is trust. And after a certain amount of time, the United States began to abuse that trust and printed more dollars than they had gold to back it up. This, as we all know, caused a global bank run, and the central banks all around the world went to exchange their dollars, hand them in to get the gold that was promised to them. After a while, we were running out of gold, and Nixon decided rather than run out of gold, we were just going to renege on our commitment to exchange dollars for gold and shut the gold window forever. But at this point, the dollar was already entrenched in global trade. It had been the global reserve currency for close to 30 years now. The United States had been printing dollars, sending them overseas, buying stuff from countries with those dollars. We would import our goods with those dollars, and those other countries were more than happy to accept dollars as payment because, number one, if they ever needed to, they knew they could just go get gold from America, and number two, they could use those dollars to buy the stuff they needed to import from other countries. And so because this system had already been in place for decades, it stuck even though those dollars weren't redeemable for gold anymore. People knew they could still get dollars as payment because other countries were still willing to accept those dollars for payment. So the system continued. The only difference was now governments and central banks had the ability to print an unlimited amount of their own currency. The only restraint on that would be political will. And of course, the other constraint, that pesky reality that if you overprint your currency, you hyperinflate it and becomes worthless. So fast forward to today. How much of that money, how many of those dollars are there in circulation today? Well, that is difficult to say, and many people actually say it's impossible to calculate. But how in the world could something so simple as just counting up all the dollars in circulation be an impossible task? Well, it comes down to one very simple word: rehypothecation. And don't worry, yes, that word sounds made up by somebody who wants to sound smart, but I'm going to illustrate it very simply with one little example. Imagine your friend is going on vacation for 6 months and they don't trust the banks. They've got $100,000 in physical paper cash under their mattress, but they need you to hold on to it for them and keep it safe for them while they're out of the country for the next 6 months. So you happily agree, you say, yes, give me that 100 grand in cash because you've got an idea. As soon as they leave, you decide to call up your buddy who is a fix and flipper. He is a home renovator, and you say, hey, I've got some hard cash for you. I'd like to make a loan to you at 10% interest so that you can go out and fix and flip another house. And he says, absolutely. Give me that 100 grand. I'll pay you 10% and I will fix and flip this house. So you do that. You give that 100 grand to your buddy, knowing that it's a hard money loan. He's going to give it back to you in 6 months, just in time for your friend to get back from vacation. You'll make 10%, or really 5% because it's half the year, for no effort of your own. But what your buddy does with it that you lend it out to is he realizes, hey, I don't actually have to fix and flip this house. Maybe I can wholesale it. And so he does a wholesale style deal, gets out from under the house in a couple of days and then realizes I've got 6 months left on this money. I don't have to give it back for 6 months. So he calls up his buddy who has a really good deal, really good hookup to get a safe return on a large chunk of cash, 3%. So he gives that money to his buddy who puts it in the account at 3%, but that 3% is what you were advertising to your friends saying, hey, if you give me money, I'll pay you 3%. So that money just went through 3 or 4 people back to you, and it's all the same money. It's been rehypothecated, loaned out from one person to the next, to the next, to the next, made its way all the way back to the original, and the whole process can start itself over again. This process can theoretically continue in an infinite growing loop where everybody creates new assets and also offsetting liabilities for themselves, making magic money on loaning the same amount of money all to each other over and over and over again. That is until your friend gets back from vacation in 6 months. Because during that 6 months, that is all fine and dandy as long as 2 things don't happen. Number 1, nobody calls a loan, and number 2, nobody defaults on a loan. Because it's the same 100 grand that's been loaned between 5 or 6 people over and over and over again. That same dollar has moved from one hand to the next, to the next, to the next, as part of a loan getting re-loaned out every time it's loaned to the next person. So if one person in that chain defaults, somebody can't fix and flip the house, somebody can't sell it for what they thought, they can't pay, that means every single other person in that chain also defaults. If your ability to repay relies on the person you loaned money to repaying you, and so on down the chain, one person not being able to repay will wipe the whole game from existence. Everybody defaults. And the exact same thing will happen if your friend suddenly comes home early from vacation and it doesn't stay 6 months, he only stays 3 months. And when he gets back, he says, you know what? I'd like my 100 grand back, please. Well, you don't have it. So you have to call the next guy and say, give me that money back early. And he has to call the next guy and the next guy, which comes back to you, which means you have to call the other guy, and so on and so forth. And there's a high degree of likelihood that one person in there will have a locked up deal that they won't be able to get out of ahead of time. Now, this hypothetical scenario understandably sounds preposterous, but this is exactly how banks operate. The same dollar moves from one bank to another, to another, to another, as it continually gets re-loaned out again and again in a process called rehypothecation. And each time this happens, the total number of dollars increases in the system because all dollars are basically just IOUs of dollars. And if all that debt were eventually to get completely repaid, you would wind up with $0 in the system. Of course, other than the actual physically printed paper dollars. Now, at this point, you're probably thinking, number 1, this sounds like a crazy problem, and number 2, what in the world does this have to do with Eurodollars? And don't worry, we're getting to that. But this is not, so far at least, as big of a problem as it might seem. Because in the United States, if one bank started to default, and that meant he couldn't pay back who he owed to, and then that meant that bank couldn't pay back to who they owed to, and so on and so forth. Well, the Federal Reserve has the tools and the precedents to step in and stop that from happening. The Federal Reserve governs all banks in the United States. They have the data and they have the rules to make sure something like this doesn't happen here. And we saw that take place in the financial crisis when they stepped in and saw that very thing happening. They stepped in and gave the banks the money they need so they didn't default and have that domino effect take out the entire financial system. And today the Federal Reserve watches exactly how much banks have in reserves, in deposits, in liabilities, in assets, and the total money supply so that they can keep track of this stuff and see if there's danger brewing here. And that's the key. I told you before that the problem with the name Eurodollars is that it has nothing to do with euros. It's not even European, and they're not really dollars. They're dollar IOUs. A better name for the Eurodollar system would be global dollar IOUs or foreign dollar IOUs. This is basically just all the dollars that are in circulation all around the world outside of the United States. And just as in the case within the United States, dollars in banks are largely dollar IOUs, which means that the Eurodollar system is a massive pile of dollar IOUs, dollars that have been loaned out over and over and over and over again from one bank to another bank to another bank, creating a massive pile of dollar IOUs all around the world. So quick historical recap on how we got to this point. Number one, in 1944, the US dollar became the global reserve currency, and countries, nations, central banks, institutions all around the world started using and accepting dollars for payment. That meant the United States started printing dollars and sending them out overseas to buy all the stuff that we need. But that means there are many dollars for almost 80 years that have been sent out overseas and are now being held in institutions that are not governed by the entity that can create those dollars, the Fed. Not only is the Federal Reserve not overseeing or regulating or in charge of any of these foreign banks, nobody is. Yes, each bank does have its own central bank in its own country that does and tries to step in to bail out its own banks if necessary when it can. But a central bank can only do one thing. They can only print their own currency. The Bank of Japan can't print dollars, they can only print yen. And it's the same with every other country. This means that if we were to have some sort of a catalyst that would spark another sort of great financial crisis happening, but overseas this time, there's no entity that can come in and recapitalize those foreign banks. In the United States, the Federal Reserve was able to step in, print new dollars, and shove them into the bank's balance sheets so that the banks had the dollars they needed for all of their IOUs that were failing. But those central banks that are governing the other banks all across the world don't have the ability to create new dollars. Only the Fed does. And so if a bank somewhere else around the world has a loan that defaults, or too many loans that defaults, or a bank run, or has too many early withdrawals, there could be a problem that their own central bank doesn't have the ability to bail them out of, because that bank needs dollars in order to redeem all of its dollar IOUs. But if it turns to its own central bank, it can only get yen, or maybe euros, or maybe pounds. And when one bank has this issue where they can't get the dollars they need, they start to go scramble to find dollars at any cost necessary, buying them from the open market by trading them for their other assets, meaning they sell their reserve, they sell their currency, they sell their assets, which pushes those prices down in exchange for pushing dollars up. And they go and try and call their loans and have people who owe them money give them the dollars, which means that those people or those institutions may need to go scramble themselves to get the dollars because they don't have them, remember? They're just dollar IOUs. So they turn to everybody who owes them dollars and asks them to give them their dollars back, and so on and so forth. This goes just like you and your friends example before. The same thing could very easily happen with financial institutions all around the world, because all these institutions have dollar IOUs made on top of dollar IOUs on top of dollar IOUs. And nobody knows exactly how many dollars are actually at the bottom of this upside down pyramid. So what's the verdict? Are we doomed? Well, maybe not. Yes, there are an untold trillions of dollars and dollar IOUs on top of those dollars in an infinite loop going back and forth to each other. And if one defaults just a little too much, it could start an unwind of the entire dollar IOU system. But let's say this happens in a country in Asia, or a country in Africa, or a country in Europe. It really does not matter where. The central bank will step in and try and stop that panic from spreading. What the central bank will do is try and recapitalize that bank. But again, remember, they need dollars, which they cannot print. So that central bank might print its own currency to buy dollars on the open market to give to its bank. It may try and sell some of its assets that it already has in order to raise money to buy dollars to give to its banks. All this means we could see extreme upward pressure on the dollar's value versus other assets and versus other currencies. This is like a deflationary death spiral on steroids, because all at once you have a global scramble for dollars as everybody tries to get enough dollars to pay back its IOUs that are all built on other people's IOUs. In a mad scramble for dollars, the value of the dollar relative to everything else could very easily overnight literally become infinite. That would cause the global financial system to grind to a halt, and would cause a lot of problems, of which the Fed, to put it lightly, does not want to see these things happen. But is there anything the Fed can do here? Well, the answer is actually yes. And over the last 3 years, we've seen the Federal Reserve take a number of steps to kind of grease the line so that if something like this were to happen, the Fed can easily get dollars, not to banks who need them, but to central banks around the world. Repo, reverse repo facility for foreign central banks, swap lines opened with other countries, a number of facilities that the Federal Reserve has set up just within the last 3 years that are not in use now, but are designed to be used should the Fed ever need to get a massive amount of dollars to the rest of the world. This would be off-market transactions, so that if the Swiss central bank needed a mad scramble for $1 trillion, they wouldn't have to sell all their reserves and all of their assets and buy those dollars on the open market, spiking the value of the dollar, spiking interest rates, tanking the value of things like treasuries. You wouldn't have to see that happen. They could go direct to the source, the Federal Reserve, swap their assets, and get dollars in its place. So in the case of the dominoes starting to fall, this house of cards starting to collapse, it may not actually be the end. We may have the infrastructure in place for the Federal Reserve to print as many trillions of dollars as necessary, give them to central banks around the world so that the central banks can get them to their own banks as much as necessary. But this does require, number one, extremely fast acting. Number two, a knowledge about exactly how many dollars are needed. Number three, the ability to create those dollars and get them exactly where they need to go. And then number four, the political will all along the way to actually be able to get that done. And we have to remember, there is no board that oversees this global dollar IOU market. There's no agency that prevents these dollars from being rehypothecated past a certain number of times. There is no regulator that keeps track of how many of these dollar IOUs there are in circulation. And there is no government that sets a certain reserve requirement on any bank around the world using dollars or lending those dollars out. So while this situation is probably safer than it was just a few years ago, the jury is still out. It is a matter of time before we see whether this house of cards will just fade away quietly or whether it will spark global contagion and take down the entire financial system with it. And if it does, you can bet that all the power-hungry bureaucrats who are in charge at the time will absolutely, definitely not let this good crisis go to waste. For those of you who are still hanging on, I'm able to make videos like this because people like you who want to protect their investments from global catastrophes like this and grow their wealth over time by being actively engaged with portfolio allocation and fundamental analysis and picking the best assets and trading to protect their portfolio and grow their portfolio. People like you have signed up for Heresy Financial University, where I am continuously creating new training, new material on all of the above to help people like you grow their wealth, maintain their wealth, and increase your financial literacy. For more on that, see the link in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.